What I do like about silver, though, is that if you melt down gold, you can melt it down from one thing and turn it into something else. You probably lose about 99.5% of gold. If you do that with silver, you actually lose 30% of the metal every time you melt it down and turn it into something else. And they anticipate that by 2030, there is going to be probably a third of silver left in the Earth's crust than there is today. So I believe that ultimately by something like 2030, silver will be worth more than gold. And look, one of my big things at the moment is that if you look at what's happened globally, the amount of money that's being printed, I don't believe you can print this much money without having a non-inflationary effect. And I use something called M1 money supply, which is just a broad measure of the amount of money that governments in the world have created. And you can clearly see that it's just risen phenomenally from where we are. And I don't know what it's like here in Hungary, where I'm based in the UK. Every time I fill my car up, it's costing me more money. Last Saturday, I had the misfortune of having to go shopping with my wife for groceries. It's costing me more money. I'm beginning to feel it in my pocket. And the reason why people are buying gold and precious metals is because they're looking for a hedge against inflation, which we believe is ultimately coming around the corner. And if you look at what's happening around the world globally at the moment, we're seeing a number of central banks are beginning to raise interest rates. The Australians, the Bank of Israel, and I think we're going to see the Americans and the Bank of England raise interest rates probably in the first quarter of next year. And then once they start, they'll have to move them up very quickly. So just an example I use to highlight what I believe is an example of inflation is that if you look at the cost of sending a child to school in America, inflation of university fees is probably running at about 7.8% per annum. So my argument is that if you speak to somebody who says, well, we're going to be entering a deflationary environment, I would disagree with that wholeheartedly, because my argument is that we already have inflation sitting in our economies at the moment that runs at about 3.5%. And look, I talked about the dollar falling in value, but it's not just the dollar that's falling in value. All currencies are falling in value. And I use something here called the DXY, which is a basket of currencies against the US dollar, which includes the euro, the sterling, the Swiss franc, the Canadian dollar, and the Swedish krona. And quite simply, you print this much money, you're debasing the value of what that money can buy. And a great example is that if you look at the Chinese, they are sitting on $3 trillion of American bills and American bonds. And they're worried because the Americans keep going off and printing more money, and what they're doing is devaluing the money that the Chinese are holding. So this is why you've seen the Chinese being very aggressive. They've been trying to buy mining businesses in Australia. They've been trying to secure mineral rights in Africa. And I was in Argentina 3 weeks ago, and they're even buying land down there to try and secure food supplies. And look, my big argument at the moment is that I believe that where we are sitting right now is very close to where we were in the 70s. And if I had to make an almost look back at where we are now, I would say that 2009 is very similar to 1974. And my argument for this is that you need to look at holding real assets, because 1970s to 1980s are pretty similar right now. We've got low interest rates, which will ultimately move higher. We've got inflation that I believe is running at about 3.5%, but I think in the next 18 months it's going to start really moving away, and we'll see central banks trying to tackle that. We've got rising unemployment, and I was just looking at Bloomberg this afternoon. The Americans believe that they'd stabilise unemployment at 10.2%. Guess what? It's gone up again. So a lot of the environment we're sitting in now is similar to the 70s. In the 70s, what happened? If you owned equities, I'll use the S&P 500 as this example, you flatlined. So you put $100 in, you probably take $100 out 10 years later. Whereas if you own a real asset, and that could be gold, it could even be art, it could be commodities, you perform much better. Conversely, if you look at what happened after that, you had a completely different scenario. You had interest rates were high, inflation was high, but they began to come down. So anything that produced a yield became attractive. So property became attractive, equities became attractive. And you can clearly see from this chart that the inverse happened, that financial assets outperformed outperformed real assets. We are not in this environment right now. I would say we are much closer to where we were in the 70s. And if you look at what happened recently, we had a scenario where interest rates were held too low, and I think Greenspan's behind a lot of what happened last year in regards to the crash. So what happened is that people were looking for a better return on their money. Bonds weren't paying anything. If you were sitting in Barclays or any other bank, you were probably getting 25 basis points. You know, property became very, very expensive. So what did people do? Well, they went away and they created these very exotic instruments like credit default swaps, mortgage-backed securities. And what that did is it ultimately led to a bust in the market. But the one asset class that came through at the end of the day was gold. Finished up the year 3.5%. Whereas if you held equities last year, you'd be wiped out. Morgan Stanley Emerging Markets Index down 52%, FTSE down 47%, S&P 500 down 51% last year. On it goes. And look, something that I've been doing recently, we've been doing quite a lot of work with the Financial Times, and I'm a big fan of economic history. What I want to do is to go back and try and understand if where we are sitting right now today, we have seen any historical precedent. And what I did is I went back as far as the 30s to the Great Depression, and I looked at what happened to the Dow Jones after they had a huge economic crash, and the markets followed down. Then I went back into the 90s and I had a look at the Nikkei in Japan to understand how that performed, and what kind of a recovery it had. You can clearly see here, this is not very good, this doesn't show up very well. Basically what happened, the Nikkei and the Dow in the 90s and further back in the 30s, they ran up, they fell down, then they made a slight recovery. But what happened after that was they began to trade sideways for years to come. And that's why the Japanese experience is often referred to as the lost decade. It's actually now the lost 20 years. But weirdly enough, and I found this quite spooky, if you look at where the S&P 500 is sitting right now today, it's almost mirroring this. So again, looking ahead, I hope I'm surprised that that's not the case, but it would seem that we are set up for a period of time where shares or equities, as whatever you want to call them, will probably just trade in a range for a number of years to come. So again, more reason why we believe you should be looking at a real asset play within your portfolio. I won't go through this in great detail, but really what this is, it's just our argument as to why you should hold real assets, i.e. you should hold real gold bullion, you should hold real platinum, you should hold silver, you should hold real oil, as opposed to owning companies that, like BP, that drill for oil, like Anglo-Plats, that mine for platinum. And the arguments are fairly straightforward, and it's a reiteration of what I said earlier. If you hold paper, it can go to zero. A real asset will always be worth something. And again, that chart really just converts into how these asset classes have performed. So these are gold mining funds. This is our gold bullion fund, and this is actual gold bullion. And our gold bullion fund is quite unusual. I think it's the only one of its kind in the world. What it does, it allows you to buy exposure to gold bullion. So not buying equity shares. You give us $100, I'll go and buy $100 worth of bullion, I'll stick it in the bank in HSBC in London, and there it sits, and it follows the price of gold.